Hey, and welcome to the channel. If we're just meeting, my name's McElroy, and on this channel here, we talk about all things personal finance and business. Pretty much anything that has to do with money, we'll talk about here. I've got videos coming out weekly, and if you're interested in more of this kind of content, consider subscribing down below. There's a lot of confusion about the differences between index funds, ETFs, and mutual funds. So today what we're going to do is we're going to look at all three of these, we're going to compare them, and hopefully by the end of this video, you'll know which one is right for you. At the end of the day, you're better off investing in any of these three funds than just not investing at all. If you're brand new to investing, you can think of a fund as basically a big bucket of assets that typically consists of stocks or bonds. The big advantage that you get from funds or this big bucket of assets is because it's a big bucket of assets. So most funds have shares in many companies. This gives you far more diversification than you would get from any individual stock. This doesn't make funds risk-free, but it certainly helps. All right, so let's talk index funds. Index funds are a type of mutual fund that are passively managed, and they seek to replicate the returns of an index, such as the Dow Jones Industrial Average, the S&P 500, or the Russell 2000. In order to match the returns of the index, these funds typically hold either all of the stocks within the index or a representative portion of all the stocks in the index. This is what makes index funds passive. Since they're trying to replicate the returns of an index and not beat them, there's really no stock picking to choose from where a manager is required, since all you're picking from are the stocks within that particular index. Active managers has to get paid when buying and selling the stocks in an actively managed fund. Since index funds are passive, you pay a significantly lower fee because you don't have to pay for that. This is great because fees cut into your return, so the lower fees, the more money in your pocket. Let's talk about ETFs. Now, ETF stands for Exchange Traded Fund, and these do share a lot of similarities with an index fund, primarily that they are typically, not always, but typically passively managed investments. Because these are passive investments, it shares the same benefit with index funds of having lower fees. The big difference between index funds and ETFs are that ETFs they function very similarly to stocks in how they're bought and sold. So they're bought and sold on an exchange, and they're priced similarly to stocks. So the price can change throughout the day. Whereas index funds are bought based on the price set at the close of the previous trading day. Because ETFs are bought and sold on an exchange, this makes them far more liquid and easier to sell quickly. So if you're going to be doing a lot of day trading, then ETFs are going to be your way to go. However, if you're looking at more long-term investing, buying and holding over time, then this advantage, it doesn't really matter. It becomes irrelevant. Mutual funds, just like ETFs and index funds, are a basket of assets. However, the way they approach that basket of assets is very different. Mutual funds are actively managed funds, meaning there is a manager who is buying and selling stocks to try to beat the market. Okay? Index funds and ETFs are trying to match the returns of the market or their index. Mutual funds are trying to beat it, right? So if the S&P 500 returns 8%, your S&P 500 index is trying to return 8%, whereas the mutual fund is trying to earn more than that 8%. This is an actively managed fund, and this is why the fees are higher, because in order to try to beat the market, it has to be managed by a professional who does this all day, every day, trying to pick stocks, buy and sell within that portfolio to try to beat the market, and you have to pay for that. The problem with the approach that mutual funds take is it's very hard to beat the market, and very few fund managers have been able to do so consistently over the long term. Anytime you hear of a mutual fund boasting of beating the market, take a look, go to Yahoo Finance or MarketWatch, and take a look at that fund's returns, compare it to the S&P 500 returns over the last 5 to 10 years, and see how long and how consistently they've been able to beat the market. Have they only beat it for the last 2 years? Have they consistently beat it over the last 5 years to 10 years? Because if they could, that's pretty impressive. And only a few managers have actually been able to do this. One notable example is Peter Lynch, who managed the Magellan Fund, Fidelity's Magellan Fund, for 13 years. He averaged a 29.2% return, which is incredible. And again, not many managers have been able to replicate that. On top of any returns, you need to consider the fees. So if you look at a mutual fund that's beaten the market over the last, let's say, 5 years, let's say they've done 10% and the market has averaged 8%. Well, if their fees are 2%, which would be really high, but I'm just saying, if their fees were 2%, then really they're just, that's cutting into your return. So really they're just matching the market because of their fees. So that's something else to consider too, is don't just look at their returns, look at the fee as well. So take the return, subtract the fee, and see what that return is, because that's really going to be what you're going to get. Because it's so hard for active funds to beat the market, index funds are typically recommended. Index funds and ETFs are typically recommended to most retail investors, or average Joe investors like you and me, to invest in. And I mean, heck, even the man, the myth, the legend himself, Warren Buffett, recommends for most people to invest in an index fund. Index funds and ETFs offer fairly consistent returns year over year, whereas mutual funds tend to be a little more sporadic. You may have 16% one year, you may have a 5% return the next year. It's very up and down, again, because it's hard to beat the market. So mutual funds can have really excellent years, they can have really poor years, or they could just match the index. However, the data has shown historically over the long term that passively managed index funds and ETFs actually beat the returns of actively managed mutual funds. Now, a caveat here, of course, is that past performance does not indicate future returns. But with the data that we have, index funds over the long term actually perform better than actively managed funds, even with those big, good years that the active funds can have. Now, I'm not trying to crap on mutual funds here, and not all mutual funds are bad, and there have been fund managers who have beaten the market over the long term, like I mentioned Peter Lynch before. However, really what I'm trying to say is, before you pick a mutual fund, go to Yahoo Finance, just take a look at their previous 5-year and 10-year returns and see what those returns were. If they've beaten the market consistently over that period of time, or for the majority of it, sure, maybe it's worth it. Also, take a look at the fees, see how high they are, and compare that to an index fund and see how that index fund has performed. A final note about the differences is the minimum investment that you put in. Now, index funds and mutual funds tend to have a higher minimum investment requirement than ETFs. So ETFs, typically the minimum requirement is just the price of one share, whereas index funds and mutual funds can be pretty high. Vanguard's VT Sachs, for example, which is their total stock market index fund, has a minimum investment of $3,000. Whereas their ETF equivalent is VTI, which as of right now, this has a share price of about $190. This can be a kind of a make or break decision for beginner investors or people who just don't have $3,000 lying around. If you don't have $3,000 lying around, then you may have to go with an ETF. Now, that said, there are no investment minimum index funds and mutual funds. Fidelity, for example, and Schwab have zero investment minimum index funds. So SWPPX is Schwab's S&P 500. That has no minimum investment. And then I don't remember the ticker symbol, but Fidelity has their zero line, which has a zero fee. These are index funds. They have a zero fee and a zero investment minimum. Now, for me, the majority of my money is going into index funds. You may have been able to guess that just based on the popularity of index funds in recent years, but this is what has worked best for me. Every month I have a dedicated portion of my income that goes to a portfolio of index funds that I have selected. One of the things that's made this a lot easier is automatic transfers from my bank account to the brokerage. This has made things so easy, so I don't even have to think about it, and there's no excuses for not saving. All I do is I set up the transfer, say how much I want, hit go, and every month now, on the same day, it takes that amount from my account. I really think this is a game changer, and automating your finances is definitely the way to go. So if you haven't tried this yet, definitely give it a shot, because I found it to be very beneficial. If you don't have automatic transfer set up, definitely give this a shot. I think automating your finances is one of the best ways that you can save more. And honestly, once you set it up, once you set up that amount, it almost feels accidental. It's pretty great. That's all for this video. I hope you learned something. Please like this video if you liked it. Hit the subscribe button. And if you didn't like it, please comment down below and let me know what you think I could do better. Until next time, thanks.